300 million ounces. That's how much physical silver JP Morgan has accumulated in their vaults over the past decade, according to COMEX warehouse reports. Not paper silver, not futures contracts. Physical metal, sitting in secure depositories with their name on it. To put that in perspective, that's more silver than most countries hold. More than the entire annual production of the world's largest silver mines combined. Roughly $9 billion worth at today's prices. And if you think a major bank stockpiling a strategic metal at this scale doesn't affect you personally, I need you to pay very close attention to what I'm about to reveal. Because JP Morgan didn't accumulate 300 million ounces by accident. They did it systematically, quietly, while the financial media was looking the other way. In this video, we're going to uncover why they did it and what it could mean for your financial future. Stick around. While you were focused on stock market headlines and crypto volatility, one of the largest financial institutions in history was executing a decade-long accumulation strategy in a market most people completely ignore: the silver market. A market so small that a single determined buyer can move prices dramatically. A market where physical supply is increasingly disconnected from paper trading. A market that major banks have been fined billions of dollars for manipulating. In 2020, JP Morgan paid $920 million to settle federal charges related to precious metals, market manipulation spanning nearly a decade. That's not conspiracy theory. That's Department of Justice prosecution. Public record. Exposed in court documents. But here's what the settlement didn't explain. Why was JP Morgan simultaneously accumulating the largest physical silver position in modern banking history while their traders were allegedly manipulating prices lower? Think about that for a moment. If you wanted to buy something, massive quantities of something, wouldn't lower prices benefit your accumulation strategy? The question isn't whether JP Morgan accumulated silver. The COMEX data proves they did. The question is why, and what they might be positioning for. Now, let me be absolutely clear about something before we continue. Everything I'm about to share comes from publicly available sources, COMEX warehouse reports, SEC filings, Federal Reserve data, court documents from the DOJ settlement, industry production statistics. This isn't speculation. This is not conspiracy theory. These are verifiable facts that anyone with an internet connection can confirm. I've linked every source in the description. What I am doing is connecting documented data points that exist in plain sight, but that mainstream financial coverage seems remarkably uninterested in discussing. When you see the complete picture, the implications are significant enough that you'll understand why this story doesn't get mainstream attention. By the end of this video, you'll understand exactly what JP Morgan has been doing in the silver market, why their positioning matters, and what similar institutional accumulation has historically signaled. Because here's what most people don't realize. This exact pattern of institutional accumulation has happened before, multiple times. In different commodities, different eras, different circumstances, but the sequence is remarkably consistent. Quiet accumulation, supply constraints, price suppression during buying, then rapid revaluation once positions are established. There's a documented pattern here. A pattern that has played out in silver specifically 3 times in the last 150 years, each time with devastating consequences for those who didn't see it coming, and enormous gains for those who positioned early. Same stages, same institutional behavior, same outcome. The only question is whether you'll recognize what's happening before the repricing occurs, or whether you'll be asking afterward how you missed what was hiding in plain sight all along. Stay with me. The next 15 minutes will change how you think about the silver market forever. To understand what JP Morgan's accumulation actually signals, you need to understand how institutional commodity positioning works. Not the simplified version, the real version that plays out when major players target strategic assets. Every significant commodity repricing in modern history has followed a precise 4-stage cycle. This isn't theory. This is documented market history, verified through over a century of commodity trading data. Stage 1, strategic accumulation. Major institutions identify an undervalued strategic asset. They begin acquiring quietly using market mechanisms that minimize price impact. Futures markets are used not for speculation, but for physical delivery. Warehouse stocks grow slowly, avoiding attention. This phase typically lasts 5 to 15 years. During this time, public sentiment is bearish or indifferent. Nobody cares. Perfect buying conditions. Stage 2, supply absorption. Available supply shrinks as institutional holdings grow, but demand continues from industrial users, investors, other buyers. The gap between paper prices and physical availability begins to widen. Delivery delays appear. Premiums emerge for actual metal. The market tightens, but prices remain suppressed by paper trading mechanisms. This phase lasts 2 to 5 years. Stage 3, disconnect recognition. This is the critical phase. The gap between paper prices and physical reality becomes undeniable. Major industrial users struggle to secure supply at quoted prices. Premium spreads explode, inventory drawdowns accelerate, the paper market mechanism begins to strain under physical demand. Short sellers face delivery demands they cannot meet. This phase lasts 6 to 18 months. The paper and physical markets reconcile violently, prices surge to reflect actual supply-demand dynamics. Those holding physical metal see dramatic gains. Those caught short face catastrophic losses. Industrial users face input cost explosions, and everyone asks the same question: how did we not see this coming? The answer is always the same. They weren't watching the warehouse data. They were watching the ticker, and the ticker was lying. Now let me prove this pattern is real. 3 historical examples. 3 commodity squeezes. Same institutional playbook, same outcome. 1979 to 1980. The Hunt brothers, Silver Corner. This is the most famous silver squeeze in history, and while the popular narrative focuses on the Hunt brothers' failure, the real lesson is about what happened before the failure, about the pattern that made them billionaires before they lost it all. Nelson Bunker Hunt and William Herbert Hunt began accumulating silver in 1973. Their thesis was simple. Real assets would outperform paper currencies during inflation. Nixon had just ended gold convertibility. Inflation was accelerating. The dollar was weakening. So they bought silver, quietly at first, then more aggressively. By 1974, they controlled an estimated 55 million ounces. Prices had risen from 2 to 6 per ounce. But they weren't done. They continued accumulating through 1975, 1976, 1977, 1978. Each year, more physical silver moved into their control. Stage 1, strategic accumulation. 7 years, patient, systematic. By 1979, the supply dynamics shifted. Available silver inventories were depleting. Industrial users faced delivery delays. The paper market price no longer reflected physical availability. Stage 2, supply absorption confirmed. Then came the recognition phase. In late 1979, COMEX warehouse stocks plummeted. Delivery demands exceeded available supply. Paper short sellers couldn't deliver physical metal. The disconnect became undeniable. Stage 3, documented in COMEX records, January 1980, silver hit 50 per ounce. A 25x increase from where the Hunts began buying. Anyone who had accumulated alongside them saw life-changing gains. Stage 4, repricing complete. Now yes, the Hunts ultimately failed. COMEX changed the rules, limiting silver purchases. The government intervened, prices collapsed. The Hunts eventually declared bankruptcy. But here's what history forgets. They were right about the thesis. They were right about the accumulation strategy. They were right about the supply dynamics. They failed because they used too much leverage, and because the rules were changed specifically to stop them. The pattern worked. The execution failed. And the lesson for today isn't about the Hunts' failure. It's about what their accumulation revealed about silver market structure, the same structure that exists today. 2010 to 2011, the Silver Liberation Movement. This example matters because it happened recently enough that COMEX data is easily verifiable, and because it reveals how the modern paper silver market actually functions. Following the 2008 financial crisis, a grassroots movement emerged. Online retail investors, frustrated with bank bailouts and currency printing, organized to buy physical silver. The goal was explicit: expose the disconnect between paper prices and physical supply. They called it Crash JP Morgan, Buy Silver. The thesis was that JP Morgan held enormous short positions in silver futures, and that coordinated physical buying could force a short squeeze. Now, whether that specific thesis was correct is debatable. What's not debatable is what happened to the market. Between August 2010 and April 2011, silver prices rose from $18 to nearly $50 per ounce, almost a 3x increase in 8 months. But here's what's crucial. During that exact period, COMEX registered silver inventory dropped from over 120 million ounces to under 95 million, a 25% drawdown, while prices were surging. The pattern was clear. Physical demand was outpacing paper supply. Stage 1 and 2 had already occurred. Major institutions, including JP Morgan, had been accumulating through the previous decade. Stage 3 was the recognition phase. Retail investors piled in. Industrial users accelerated purchases. Coin dealers reported sold-out inventory premiums for physical silver spiked to 20-30% above spot prices. Stage 4, the repricing, $18 to $50. Then, once again, intervention. In rapid succession, COMEX raised margin requirements 5 times in 8 days. Leveraged long positions were forced to liquidate. Prices crashed 35% in a week. But notice what didn't change. JP Morgan's physical position. Their vault holdings actually increased during the crash. They used the paper price collapse to acquire more physical metal at lower prices. The pattern holds. Stage 1 through 4, followed by rule changes that crashed prices, followed by continued institutional accumulation. This isn't speculation. This is COMEX warehouse data, publicly available, easily verified. 2020 to 2021. The Reddit silver squeeze. This example is crucial because it happened 4 years ago. The data is fresh, and because it exposed structural vulnerabilities in the silver market that remain unresolved today. In late January 2021, retail investors on Reddit's Wall Street bets, fresh from squeezing GameStop stock, turned their attention to silver. The thesis was similar to 2011, force a short squeeze by demanding physical delivery. Within days, silver surged from $25 to over $30. Coin dealers across America reported complete inventory depletion. The U.S. Mint suspended Silver Eagle production due to blank shortages. Premiums for physical silver reached 50% above spot prices. Physical silver and paper silver became two different markets. You could see the quoted price on your screen. You just couldn't buy actual metal at that price anywhere. COMEX warehouse stocks dropped by over 70 million ounces in the following months. The drain was documented in their daily reports, undeniable, verifiable. But here's where it gets interesting. Throughout this entire period, JP Morgan's warehouse holdings remained stable or increased. According to COMEX vault data, they didn't sell into the frenzy they held. And in some months, they added. The paper price was eventually crushed through margin increases and derivative pressure. Silver fell back to $22 by late 2022. Retail investors lost money on their paper positions. But the physical market never normalized. Premiums remained elevated, delivery delays persisted. The disconnect between paper price and physical availability became a permanent feature of the market. 3 examples spanning 40 years, same pattern, same institutional behavior, same outcome: accumulation, absorption, disconnect, repricing, intervention, continued accumulation. The cycle repeats because the structure does not change, and the structure favors those who hold physical metal over those who trade paper contracts. Now let me show you where we are today, and why JP Morgan's 300 million ounce position matters more than ever. According to COMEX warehouse reports, total registered silver inventory currently sits near multi-decade lows. Registered silver is metal available for delivery against futures contracts. It's the actual supply backing the paper market. In 2021, registered silver peaked at over 150 million ounces. Today, it fluctuates between 25 and 35 million ounces. That's a 75 to 80% decline in deliverable supply. Let me repeat that. The silver available to back futures contracts has dropped by over 75% in 4 years, while industrial demand has increased, while investment demand has grown, while JP Morgan has maintained or grown their physical position. The ratio of paper claims to physical silver is now estimated at over 300 to 1, meaning for every ounce of real silver, there are 300 ounces of paper contracts claiming to represent silver. That's not a market. That's a confidence game. It works until someone demands delivery. Now, let me show you why silver demand is structurally increasing. Solar panels. Each gigawatt of solar capacity requires approximately 20 tons of silver. Global solar installations are growing 25-30% annually. By 2030, solar alone could consume over 50% of annual silver mine production. Electric vehicles. Each EV uses approximately 25-50 grams of silver in various components. With EV production scaling exponentially, automotive silver demand is projected to triple by 2030. Electronics, 5G infrastructure, AI data centers, consumer devices all require silver for conductivity. There is no substitute with equivalent performance. Medicine. Silver's antimicrobial properties make it essential for wound care, medical devices, hospital equipment. Demand grows with aging populations. These aren't speculative future uses. These are current applications with documented growth trajectories. Meanwhile, silver mine production has been flat or declining for years. Major deposits are depleting. New discoveries are rare. The average lead time from discovery to production is 15-20 years. Demand is rising. Supply is constrained. Inventories are draining. This is the setup for stage 3, disconnect recognition, and JP Morgan appears to have positioned for exactly this scenario. Their 300 million ounce position represents roughly 10 months of global mine production, in a market where deliverable inventory is 25 to 30 million ounces, in a market where paper claims exceed physical supply by 300 to 1. When, not if, the paper market mechanism fails to deliver physical silver at quoted prices, who benefits? The institution holding physical metal. the institution that accumulated for over a decade while prices were suppressed. Some analysts suggest JP Morgan's position could be worth 30 to 50 billion in a significant repricing event, possibly more in an extreme scenario. They didn't accumulate 300 million ounces because they're bullish on the current price. They accumulated because they see where the price must eventually go when paper and physical reconcile. The same pattern, the same positioning, the same likely outcome. Now, I know what some of you are thinking. Let me address the counter-arguments directly. But silver has been suppressed for years. It never goes up. The banks always win. Fair observation. But ask yourself, why would banks maintain the largest physical position in history if they didn't expect eventual price appreciation? Why would they pay $920 million in fines? Accept the reputational damage? Continue accumulating? JP Morgan didn't accumulate 300 million ounces to watch it stay at $30 forever. They accumulated because they expect significant repricing. Their position tells you their actual view, regardless of what their analysts say publicly. But they can just print more paper contracts. They control the market. They control the paper market. They don't control physical supply. They don't control industrial demand. Paper contracts work until someone needs real silver and can't get it. And when Apple or Tesla or Samsung can't secure silver for production, they don't accept a paper contract. Industrial demand is inelastic. It doesn't care about COMEX prices. It needs actual silver. But new mines will come online. Supply will increase. Central banks are accumulating gold at record pace. China has added over 300 tons in recent years. Russia, India, Turkey, all buying. That's publicly documented by the World Gold Council. Is it conspiracy theory when central banks do it with gold? Then why would it be conspiracy theory when commercial banks do it with silver? The data is public. The COMEX warehouse reports are public. The DOJ settlement is public. This isn't theory. This is documented institutional behavior. I'm not a financial advisor. I can't tell you what to do with your money, but I can share what the data suggests and what historically informed investors have considered when facing similar situations. First, understand the market structure. Silver is not like stocks or bonds. Physical supply is constrained. Paper markets can disconnect from reality. ETFs, futures contracts, and unallocated accounts are paper claims. They give you price exposure. They don't give you metal. In a true supply crisis, paper claims may not be honored at face value. If you're interested in silver for insurance purposes rather than speculation, physical ownership through reputable dealers provides different risk characteristics than paper instruments. Third, understand the timeline. Stage 3 transitions don't last forever. Historically, the disconnect recognition phase lasts 6 to 18 months before repricing occurs. If current supply trends continue, the window for accumulation at current prices may be limited. I'm not predicting specific timing. I'm sharing what historical patterns suggest about the duration of these phases. Fifth, stay informed. The silver market provides leading indicators before major moves. COMEX inventory levels, premium spreads between paper and physical, delivery demand versus available supply, mint sales data. These metrics are publicly available. Watching them gives you advance warning of developing pressures. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly which precious metals positions historically performed best during currency instability, the specific premiums and structures that minimized risk, and the timing indicators that signaled optimal entry points. I read every comment. This channel grows through engaged discussion with people who take financial education seriously. JP Morgan did not accumulate 300 million ounces of silver by accident. They did not pay 920 million in fines because the silver market is boring. Their actions tell you their actual expectations. Regardless of what anyone says publicly, the warehouse data is public. The supply constraints are documented. The demand growth is measurable. The pattern is historical. You don't have to make the same bet JP Morgan is making. But you should at least understand that the bet is being made. And you should at least consider what it means when the largest bank in America is positioned for something most people aren't even watching. The information is here. The data is public. The choice is yours. Thanks for watching The Silent Economy. And remember, the people who benefit from these transitions aren't always the ones with the most money. They're the ones who paid attention when everyone else was looking somewhere else.